Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be talking about patterns within consolidation. Now, as we all know, the market is doing really one of two things at all times. It's either in a trend or, well, it isn't. The thing is, the market isn't in a trend like 60+% of the time typically. So that means that it's in a type of consolidation or a correction phase. Well, if the market is in consolidation or correction phasing most of the time, or the majority of the time, then we have to know the best way to approach the market during those times and to really understand what those times are, what is happening there. Now, within the consolidation, there are three primary things that I like looking for: two-legged moves, order flow top weighting, and pick your pocket traps, or Pip Traps, as we jokingly call them on the YouTube side of things here. So those are the three primary things that I like looking for in these areas. But one thing that we have to really figure out first is, well, what is the consolidation? What is it showing us? What is it doing? And a consolidation is nothing more than a decision that hasn't been made yet. They're still trying to figure out what they want to do, and that's why it's so important to look at what happened before the consolidation began. As an example, with the market over here dropping to the downside, this is the first time after it's gone screaming higher. I may not want to be on the short side here, and in fact, my first inclination would be that this consolidation here is bulls trying to get another leg to the upside. They obviously failed and rolled back to the downside, but what do we have then? We've got a drive down, a consolidation, and a continuation lower. What was this consolidation? This consolidation was nothing more than sellers re-upping their positions to the downside and driving the market lower. After the market drove lower, we move back up, we go into consolidation, and then it breaks back down. What was this consolidation? This consolidation was nothing more than a time for sellers to go back into the downside and push the market lower. Again, preceding trend. We dive back to the downside again, start going back up. Really short-term range, but again, breaks down. Sideways consolidation shows us that the trend is still down. So when the market comes back over here, the assumption is out of this sideways range that, well, they're sellers, right? Of course. Why wouldn't they be? So when they fail to go down and rotate back to the upside, it's no shock why the response above was so aggressive, because all of the shorts were assuming that this was going to be the breakdown point for the next move. And then it wasn't. So all of these shorts become trapped, and that's a whole other video. So really what we want to do here is zoom in a little bit into what is happening after typically a large move has taken place and wait for the market to go a bit more sideways. Sideways is relative to how close or how far away you are zoomed in. You'll notice I'm pretty far zoomed out. So if I'm looking for a continuation, let's just take right now as an example. If we were to freeze the screen right where it is, what is the assumption that is taking place? Well, we had that last move that we were just talking about there, and the rally to the upside is likely a lot of sellers getting, ran over, and bulls taking over the move. When we're pulling back then, my assumption would be once we start migrating sideways, I would want to be a buyer. But while the market's not making new highs and it's continuously slipping to the downside, this isn't what you want to see. So from the perspective of the bulls, this is where I would implement one of my favorite things, which is order flow. And this would be the first pattern within this consolidation, is just tracking from the top because I want to be a bull. So I'm going from the top all the way to where we are now. And I want to see, where does the POC end up within this? This POC demonstrates to me where the majority of volume has taken place, whether they're longs or whether they're shorts. Remember, this could go up or it could go down. We don't know. But what I do know is that all of their orders, by the majority at least, have traded at 15,400 for one reason or another. So what I need to do is I need to wait for this POC to demonstrate to me who has won. I'm approaching this from a bullish perspective because the market has gone up before it went into this consolidation. So what I want to see here is a move that's rejecting the POC, showing that it's there, getting some sellers maybe even trapped in, and then breaking above it. After they break above it, get a nice little pullback, and that would be the continuation play to the upside. That is one of my favorite types of moves when we're looking at this consolidation phasing going on, preceding another trend, is waiting for the order flow to dictate when to get in, when to get out, and to show you, what should we realistically expect. I can't expect to be a bull here if we're underneath all of the volume. That would tell me that these are sellers. They're still holding, right? We got to get through them and get them out of our way first. Now, one of my other favorite patterns is looking at two-legged moves. In a two-legged move, what I mean by this is seeing the market replicate itself twice. It should be pretty obvious given the name, but we want to see that initial drive down, copy-paste that leg over, and get down to a measured leg. And once the market reaches out to a measured leg, that is going to be a major zone of support. And typically, what I really want to see here to add some gusto to this is the range to be forming up here and the breakout to be the first attempt from the sellers, right? So we've got the consolidation, we've got the back and forth going on, but realistically, the overall trend is still up and we're expecting the bulls to show up to the party. So a two-legged corrective phase to the downside offers up a perfect spot. The nice thing about this is, if you're wrong, you realistically don't have to risk a whole lot for this type of trade. That does mean that the probability is going to be a little bit lower, but if it's getting down to beyond here, we're not holding the same thing. It's not a measured move anymore. It's gone through it. And traders know that, so they'll show up to the party with limited risk, usually down a good maybe 20 to 25% of the distance, with upside objectives typically back up towards the highs or somewhere inside of the highs at structure. If you were looking at that from a risk-reward standpoint, that's a really nice risk-reward. It's about 2 to 1, and it's not even to the highs. It'd be 3 to 1 almost up to the highs. And that's why a lot of traders like these types of things, and why it's one of my favorite types of moves, is getting that two-legged trap that forms a small little consolidation, dips low, gets the little trap, and rotates right back to the upside. Fantastic situation for a two-legged correction. And then the last one is going to be the Pip Trap, the PYP Trap. The pick your pocket is what that stands for. It's a joke that we kind of came up with on the YouTube side of things. And it's one of those that we've talked about several times before, but we really haven't had an appealing name for it. And you have this situation where you've got an overall trend that's working its way up. And a lot of traders are trying to figure out, well, where do I put my stop? You know, I want to stay in this thing, but where do I put my stop? If I bought in here, and, you know, maybe the market had done, you know, whatever from before there, but I bought in here, and I'm trying to figure out where do I trail my stop? Well, natural human inclination is going to put a stop underneath the last swing, move it up to the next one, move it up to the next one. But the problem is a lot of traders will do this, where you've got these little inside swings that are not confirmed. Those are non-confirmed swings. A confirmed swing requires a new high to be proving that it's a confirmed swing low. Traders will move their stops up too soon, get taken out on those stops just to see it roll all the way back in their direction. And you can take this a step further when you're looking at the next move, which would be taking out one of these previous, and this is my favorite, one of these pip traps, taking out one of the previous swings, dropping all of those stops, and then seeing it go woof all the way right back up in your direction. The reason these are so powerful is because they offer up some of the best risk reward that you can get your hands on, and they usually look something more like this. Let me get this looking a little better here, because a lot of traders will be able to buy in on that nice little dip and not have to risk a whole lot, right? If they're buying in on that previous swing, they can be buying here with a stop down into here. Or if they're buying the previous swing here, they only have to risk to the next swing. But the upside is usually always 2 to 1, sometimes 3, all the way up to 5 to 1. They have an incredible potential. But the important thing here is that we get that out of a consolidation. We get that within a consolidation, or on the outside of a consolidation. This would be a good example, actually exactly what we were talking about. The bulls show up to the party, they get the bounce, but they don't necessarily follow through the big rally. We have another consolidation and a roll back to the downside. Now, within this consolidation, if you look backward just before that happened, that right there is a pip trap. I love those pip traps. These are zones of interest where traders, they have an initial short, right? Maybe they took a short here, and it goes all the way down. They might, maybe they even grab some targets down there. Pushes back up, maybe they sell a little more, take a little more profit, comes back, but this time it doesn't go all the way down to the lows. Well, crap, now what do I do? What are they going to do? Well, they put their stops above where? They put their stops above the nearest swing high. Well, we know that that's a terrible location because this is not a confirmed swing high, but that's where they place their stops. And traders know this. So what a lot of traders will do is they'll sell there with a stop above the next high, and the reward, and this is why traders take this, is back down to the lows. Look at how much reward can get built into that, and it went even further. That is a perfect example of a pip trap. We have the preceding downtrend working its way lower. The bulls are failing perpetually. And we just trapped above the top with very minimal risk. Even if you didn't see the trap happen, it offered up a really nice bear bar. And you can see sellers even came in a little bit later to push it back down. Really nice example of a pip trap. So either way you're approaching consolidations and how to approach them, again, I like the three different things: two-legged moves, order flows, and pip traps. Those are my favorites. But regardless, just understanding what a range is. A range is just the spring coiling up before a decision is made. We don't know who has won that decision yet until the spring breaks, until it bounces, right? Until it blows apart, and then we know who won. But until then, that's where all of the bets are taking place. Sellers selling on the high, buyers buying on the low of that short-term range, and whoever's going to be right. I like using the preceding trend to give me a bias because more often than not, it helps enough to make it worthwhile, right? It's something that I definitely like using. But just understanding that they're a coiling spring. Something is about to happen. You might not necessarily know what, but we can have a general idea based on some of the patterns that we just talked about and where we can strike and how to approach it given what was going on before the range occurred. Hopefully you find this video useful. If you have any questions, though, feel free to drop them in the comments below, or if you have a more detailed question, you can always shoot me an email, jhb@ssftg.com. Until the next one, we will see you all then. Thanks.